Modern Investing Techniques, Episode 18. Air date, Monday, April 13th, 2026. Patrick, Vancouver. Target length, approximately 15 to 16 minutes. Happy Monday, everyone, and welcome back to Modern Investing Techniques, Episode 18. It's April 13th, 2026, and I'm Patrick, coming to you from Vancouver. Mondays are when the fresh setups appear, when the news flow from the weekend starts to crystallize into tradable edges. Today we're going to dissect the week ahead, separate the signal from the noise, and identify exactly where disciplined Canadian investors can find an edge over simple index fund returns. Whether you're managing a TFSA, an RRSP, or a non-registered account, the goal is the same: turn information into repeatable process. Let's dive in. First, the standard disclaimer that I never want you to skip. Everything we discuss on this show is for educational and entertainment purposes only. The practice investment of the day is a simulated trade using no real money. I am not a licensed financial advisor. This is not financial advice, and nothing here should be taken as a recommendation to buy or sell any security. Markets involve risk of loss. Past performance does not predict future results. Always do your own research and consult a licensed professional before putting real capital to work. The host and NARA network have no fiduciary relationship with any listener. Let's start with the macro picture that's moving markets this morning. Over the weekend, we saw two significant policy moves on opposite sides of the planet that both point in the same direction: lower input costs for businesses. Germany announced a 1.6 billion euros, roughly $1.9 billion USD, fuel relief package aimed at easing energy burdens on households and industry. At the same time, the Philippines removed excise taxes on kerosene and liquefied petroleum gas, a direct cut that flows straight to transportation, logistics, and consumer goods companies across Southeast Asia. When you step back, these are classic margin expansion catalysts. Fuel and energy typically sit inside cost of goods sold or selling, general and administrative lines. Every dollar shaved off those costs drops directly to the bottom line and, more importantly, to free cash flow. European consumer staples, industrials, and Asian exporters that burn diesel or rely on imported LPG suddenly look more attractive. For Canadian investors, the read-through is clear. Many of the same dynamics affect our resource-heavy TSX. Lower global energy costs can support margins in everything from grocery chains to trucking firms to gold miners that use massive amounts of diesel underground. That's why we're seeing early strength in energy and materials names today. Looking at the tape, North American markets are mixed, but with a slight upward bias. The TSX Composite is leading the way, currently quoted at 33,696, up a solid 0.7%. The NASDAQ Composite sits at 22,903, up 0.4%, while the S&P 500 is essentially flat at 6,817, down a negligible 0.1%. That outperformance by the TSX makes sense given our heavy weighting toward resources and materials that are directly helped by falling input costs. At the same time, geopolitical headlines around Iran, the Strait of Hormuz, and related policy statements continue to keep implied volatility elevated. So we have a classic setup: supportive fundamentals on costs, but headline risk that can create short-term dislocations. Canadian investors should be watching how these global cost pressures translate through the TSX, especially inside resource, consumer staples, and industrial sectors. Tax season is also in full swing, which means TFSA and RRSP contribution room management is more important than ever. The CRA deadline is looming, and every dollar you leave on the table in unused registered account space is a permanent loss of tax-sheltered compounding. With the capital gains inclusion rate now sitting at 66.67% on gains above $250, the penalty for sloppy tax mechanics has never been higher. That reality makes the defensive side of investing just as important as the offensive side, which brings us to today's repeatable strategy. Today's twin announcements from Germany and the Philippines provide a textbook catalyst. Lower diesel and LPG prices flow directly into consumer-facing businesses, logistics operators, food processors, and even mining companies. The result is usually an upward revision in free cash flow forecasts and, eventually, higher valuation multiples. Implementation is surprisingly accessible on platforms most of you already use: Questrade, Wealthsimple, or Interactive Brokers. Here's how I do it in practice. First, screen for companies with high fuel or energy exposure. Pull their latest annual reports or 10K/20F filings, and look at the percentage of cost of goods sold or SG&A that is energy related. Anything above 8 to 10% is worth flagging. Next, compare forward price to earnings ratios before and after the relief announcement. You're looking for names where the multiple has not yet expanded to reflect the new margin profile. Enter on the first 2 to 3 days of confirmed policy language when volume confirms institutional interest. I size these positions at 3 to 5% of the overall portfolio, never larger, and I set a trailing stop 5 to 7% below entry to protect gains once the move is underway. Historically, these relief-driven rotations work best in the first 30 to 60 days after the package is announced. That's the window when analysts are still revising estimates upward but before the move is fully in the price. Always cross-reference volume. Relief-driven moves that trade above the 20-day average volume carry materially higher probability. Of course, no strategy is guaranteed. Risks include sudden policy reversal, offsetting spikes in other commodities like copper or steel, or a broader market risk-off event that swamps the positive catalyst. That's why we never treat these as sure things. We treat them as high-probability, asymmetric setups with clearly defined risk. Imagine this scenario. On March 15th, you sold 200 shares of a Canadian mining name inside your TFSA after it dropped 12%. The order filled at $18.40, booking what looked like a clean $480 capital loss you planned to use to offset gains in your non-registered account. 18 days later, you repurchased the identical shares, but this time inside your RRSP. The CRA applied the superficial loss rule and denied the entire tax benefit. The rule is brutally simple. If you or an affiliated person acquire an identical property 30 days before or after the sale, the capital loss is disallowed. That creates a 61-day window that is completely unforgiving. Buying in a different account through a spouse or even inside a corporation you control can trigger it. In the current 2025 to 2026 tax environment, with the inclusion rate at 66.67%, above $250, a denied $10, capital loss cost you roughly $2, $222 in immediate tax deferral, and that's before compounding is considered. The fix is elegant but requires discipline. Professionals maintain a substitute basket of highly correlated but non-identical securities. Same sector, similar beta, different ticker. You stay invested while the 61-day clock runs, then rotate back if you wish. Before every sale, check the adjusted cost-based tracker in your brokerage portal. Run a 61-day forward calendar check and document your substitute names in advance. The single biggest mistake is assuming that account silos protect you. They don't. This one mechanic, proper loss harvesting with substitute securities, prevents more surprise tax bills than any other retail error I've seen. You can start applying it in your own portfolio this week. This is a simulated trade for educational purposes only. No real money is involved, and it is not financial advice. Our practice investment this week is a weekly hold on WRLG, West Red Lake Gold Mines Limited, trading on the TSX Venture Exchange. The strategy is a high-grade drill result catalyst play inside the prolific Red Lake Gold District in Ontario. We're betting on continued resource expansion momentum at a 100% owned asset. The catalyst dropped over the weekend. Exceptional drill intercepts at the Austin 904 complex of the Madsen mine. Highlights include 215.46 grams per ton gold over 5.35 meters, 50.34 grams per ton over 4.05 meters, and 61.70 grams per ton over 3.0 meters. These are not just headline-grabbing numbers, they demonstrate thick, high-grade mineralization in a jurisdiction with decades of production history. When you see intercepts like this in a district that has already produced millions of ounces, the market tends to price in the possibility of meaningful resource growth. On the technical side, the stock has been consolidating above its 200-day moving average on the daily chart, a sign that the longer-term uptrend remains intact. Today's news flow is expected to drive volume well above the 20-day average, which adds conviction. Nearest support sits at the recent swing low, while resistance is defined by the 52-week high. For risk management, I am using an 8% stop loss below entry. That limits the maximum acceptable loss on the position given that a gold price pullback or disappointing follow-up assays could quickly pressure a junior name. The Forget for this weekly hold is 6 to 12% by Friday's close. My confidence level is medium. We have a strong geological catalyst and clear district momentum, but junior gold equities remain sensitive to broader metal prices and overall market risk appetite. That balance of factors puts us squarely in medium confidence territory. This trade is valuable even if it ends flat or negative. It demonstrates exactly how to evaluate drill results, looking at grade, width, location relative to existing resources, and whether the intercept is likely to move the needle on the next resource update. These are repeatable skills that separate headline hype from economically meaningful discoveries. Predefining both your stop loss and your target before you click buy is the discipline that ultimately lets retail investors outperform the S&P 500 or TSX Composite over time. Last week's weekly hold was SSNLF, an earnings surprise momentum play tied to artificial intelligence memory chip demand. We simulated entry at $65.21 at Monday's open and exited at the same price on Friday's close. That produced a 0.00% return, or exactly $0 on a $1,000 simulated position. Our running simulated portfolio now stands at up $33.85 across 6 trades. The win rate sits at 33%. 2 wins, 2 losses, and 2 break-evens. The current streak is even. A flat result on what looked like a strong fundamental catalyst is instructive. It reminds us that even excellent earnings beats can be fully priced in by the time the market opens on Monday. Going forward, we will tighten the filter. We want both an earnings beat and expanding forward guidance before we commit capital. This zero return trade also reinforces the value of waiting for post-announcement pullbacks rather than chasing initial gaps. These are the small process improvements that compound into meaningful outperformance. First, BitGo Prime has added Tradius to its liquidity network. For accredited investors and family offices, this means deeper order books and tighter spreads in crypto markets. For Canadians holding crypto inside TFSAs or non-registered accounts, the improvement in execution quality is meaningful, reduced slippage on larger rebalancing trades, and cleaner audit trails. If you have $100, $1,000 or more in crypto exposure, it's worth exploring Prime Access to bring professional-grade liquidity into your alternative assets sleeve. Second, Bank of America's equity research feed now delivers real-time alerts the moment analysts adjust price targets on artificial intelligence-exposed names. Setting custom notifications for stocks like TSMC and Ericsson lets you act on revisions. For example, a $500 target raise driven by AI demand before the broader market digests the news. Canadian users can pipe those alerts straight into Interactive Brokers or Questrade watch lists for seamless execution. When you combine these alerts with the rotation strategies we discussed earlier, you turn slow-moving analyst notes into a genuine executable edge. Miami's ultra-luxury real estate market continues to show remarkable resilience. The implosion of the 25-year-old Mandarin Oriental site to make way for a $1 billion redevelopment underscores sustained demand from high-net-worth migration. Investors may want to consider listed luxury hospitality REITs or U.S. commercial real estate plays that benefit from this demographic tailwind. Meanwhile, the 20 wealthiest Asian families have now amassed a collective $647 billion, much of it built through strategic stakes in artificial intelligence supply chains stretching from Samsung to Reliance Industries. Canadian investors can use this as a screen for thematic ETFs or individual names that capture Asian AI capital expenditure growth rather than simply chasing the same U.S. megacaps everyone else owns. Christopher Liu's timely reminder is worth repeating. Missing the CRA tax filing deadline triggers interest charges, potential benefit reductions, and delayed refunds. Review your TFSA and RRSP contribution room today. File electronically, and treat tax efficiency as the foundation of every after-tax return you generate. Finally, results from 3 federal by-elections tonight could hand Prime Minister Mark Carney's Liberals a majority government. A strengthened mandate would likely accelerate fiscal and regulatory clarity. We will be watching the TSX reaction tomorrow for shifts in financials, energy, and infrastructure sectors. Our SI accumulated portfolio across 6 trades shows a cumulative profit and loss of $33.85. That works out to an average return per trade of 0.57% with a 33% win rate. The best trade delivered 7.88%. The worst was minus 7.49%. Our AI analysis is learning from patterns like fully priced catalysts and is adjusting filters accordingly. exactly how you improve as an investor over time. Before we wrap, keep an eye on tonight's by-election results and how they may influence tomorrow's TSX Open, particularly inside financials, energy, and infrastructure. That's your modern investing techniques for today. Every episode is designed to make you a sharper, more disciplined investor. If you're finding value, please subscribe, leave a review, and tell a friend. We'll be back tomorrow with fresh market intelligence and another practice investment. Until then, trade safe, stay disciplined, and I'll see you in the next episode. 347. This podcast is curated by Patrick, but generated using AI voice synthesis of my voice using ElevenLabs. The primary reason to do this is I unfortunately don't have the time to be consistent with generating all the content and wanted to focus on creating consistent and regular episodes for all the themes that I enjoy, and I hope others do as well.